So, Anirudh, you also mentioned about the star funds, like you had highlighted. Similarly, we come across, jargons like Flavor of the Month Fund. What's your view on those? And do you think it would be a good idea to select those funds?
No. So when your journey is long, so equities are a long-term investing journey, right? I mean, it's not a month or two. A lot of people misunderstand equities as a speculation tool, and I think that's where people go wrong right off the bat. Equities are not a speculation tool at all. There are equity mutual funds, especially. So there are far better speculation tools available, right? Go to a casino in Las Vegas. I think that's a better speculation tool. Or leverage, buy some FNO, dabble a little. Those are speculation tools. So I think when you get into this flavor of the month mindset, of always trying to pick the best performer over the next 1 year or 3 months or 4 months, I think it's the most dangerous thing that you can do with equities, because you've automatically benchmarked your long-term decision based on a short-term trend, right? And what happens is basically neither markets nor returns can be predicted, right? And I have so often seen, Sumana, that the biggest drops in a particular fund precede their best phases, right? Because I've seen that they're cyclical. A fund manager may have got one bet wrong, or for some odd reason, some of their stocks didn't realize value, right? I can't control when the market is going to realize the value of my portfolio. I may have made some fabulous investing decisions, but ultimately returns are a factor of the markets, right? So often people end up getting off the train, and then they jump back on, and then what happens is they're prancing around as if on hot coals, and in the end they end up missing the best phases of a particular fund's performance because they exited too soon. Multiple behavioral biases come to the fore, and in the end the biggest loser is the investor. So that flavor of the month thing I've never subscribed to. It is almost impossible, according to us, to predict which fund is going to perform the best over the next 3-4 months, or even 6 months, or for that matter, even the next 1 year, because there are so many variables in play when it comes to equities. I will allude to an example of a very old, I think it's one of the oldest blue chip funds. It was launched some 28 years back. It has a CAGR of 19%, right? Now, 19% is a lot. You know the impact of a 19% compounded average over 28 years. That means 1 lakh would have grown to 1.3 crores, right? Now, this fund has a 2-star rating, and it's been a compounder par excellence. But how many people do I know who've actually earned 19% over 28 years? None. Okay, this is the reason, because a fund will fall in and out of favor. Sometimes it'll do badly, sometimes it'll do well. In the long run, if the fund has strong fundamentals, right? If there's a solid fund management team, if the AMC has a good pedigree, they will ride out these phases. And in the long run, all these things will get averaged out. So I've strongly discouraged investors from trying to pick the best performing flavor of the month fund over the next quarter, month, year, and just stick with funds that have very strong fundamentals. So I'm a big fan of evaluating a particular equity fund from a qualitative framework rather than quantitative, based on metrics and numbers.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.